Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to the upcoming Bank of Japan interest rate decision taking place on Friday, the 26th of April. Certainly, this is going to be an interesting one, if not for the decision that's going to be made by the Bank of Japan members, but more so the tone that's going to be struck after they recently moved out of negative rates for the first time in 17 years. The question mark now is, will they go further, and when will that happen? Well, market expectations do point towards a likely further rate hikes coming throughout the course of this year. The next one currently being priced in for July. As you can see here, markets attributing a 91% chance that we keep rates steady this time around. But July, we see just a 27% expectation for them to keep rates as is. And instead, everyone expects that we're going to see potentially another 2 rate hikes over the course of the year, culminating in the back end of the year, where you can see roughly a sort of 75 or sort of 3/4 chance that we see interest rates hiked by 20 basis points from where we are at the moment. Of course, you see other central banks focusing on 25 basis point moves at a time. Things aren't necessarily the same for Japan. They have, of course, been dealing with disinflation and below target inflation for decades. And so this recent above target inflation period really has been an opportunity for them to try and install an environment of inflation back into an economy. This has been an opportunity, and the feeling is that they have managed to gain that traction. We've seen above target inflation for some time now, and so you're seeing growing confidence that they can normalize monetary policy. Of course, over this period of time where we've seen other central banks moving through the gears in terms of raising interest rates with a view to driving down inflation, that has not been the case in Japan. They've kept interest rates below zero with a view to driving up inflation and keeping it there, instilling elevated wage expectations, and that therefore really starts to turn a corner in terms of expectations for price increases down the line. You can see that here with the relationship between wage growth in Japan and the inflation rate. Both of them are now drifting somewhat lower, but relatively steady above target. And the expectation here is that they will be able to maintain that going forward. So there's a feeling of confidence that the job has been done to an extent. Of course, we're seeing those secondary inflation pressures start to build elsewhere around the globe, most notably within the US. And so there's some question marks about whether we're going to see similar kind of effects playing out in Japan. So certainly, as markets expect, there will be further rate hikes over the course of this year. But what will happen this time around is really going to come down to the rhetoric from the central bank and whether they want to lay the groundwork for further interest rates over the course of the year. And what would that do for markets? Well, let me guide you through a few different charts and ultimately take you through an outlook from both the equities side of things and for the FX side of things. First and foremost, here is a chart which highlights essentially the relationship between treasury yields and inflation. This is something that many people will be aware of, but ultimately with higher inflation expectations, recently we have seen yields rising in anticipation of that. You can see that perfectly on the bottom, where US inflation rate has been struggling to drive lower, but we've seen the 10-year yields rising as people fear that we might see higher for longer in terms of interest rates, and that we might not necessarily be able to drive down inflation. And so over in Japan, you can see the top section, that orange line, has been rising gradually following a period where we've seen it largely sort of flatlining, and we've seen those yields start to rise. The expectation is that we are going to see inflation back in the Japanese economy, and that has been exactly what's been playing out. The drift lower that we've been seeing of late doesn't necessarily impact what's happening in terms of yields, because we're seeing Japanese yields moving towards the upside in anticipation of those further rate hikes that we're talking about today. Here's a chart which shows you a number of different things. First and foremost, we've got the relationship between the Fed funds rate and the Japanese interest rate. And we can see here that the decline in terms of that ratio has impacted a number of different things. Now, first and foremost, we've already mentioned the fact that the expectations and the actual sort of moves within central banks in terms of their main policy rate do significantly impact the likes of the 10-year yield. And so you can see exactly that here, the close correlation between the purple line, which is the ratio between the Japanese and the US 10-year yields, and then the relationship between the Fed funds rate and the main policy rate at the Bank of Japan, which is in the orange line. I've inverted the dollar yen chart as well. So you can see that again, the decline in terms of dollar yen essentially is a relationship between the yields in the US and Japan, which is a relationship of the policy rates and the outlook for monetary policy from the central banks. So what would this mean? Well, this would mean that essentially if you were looking for any shift in this, which means, say, the likes of the Fed starting to cut interest rates at the same time that the Bank of Japan raise interest rates further, you could potentially see a reversal of some of the moves that we have been seeing in terms of both the yields, but also crucially in terms of the likes of dollar yen. Turning to the relationship between dollar yen and the Nikkei, you can see here the close correlation. So the higher that dollar yen goes, the better the Nikkei 225 goes. Now, there's a number of reasons for this, but it's notable that Japanese businesses do manage to take advantage of a weaker yen. It means that their product is more competitive around the world from a pricing perspective, so they have higher demand. So it stands to reason that if a business is able to export more and sell more to around the world, they will have greater revenues. Similarly, if they were selling their goods abroad and they're earning in, say, US dollars, or they're earning in pounds and they're reporting in the Japanese yen, the strength of those foreign earnings, of course, are increased with the continued devaluation of the Japanese yen. So whilst we have seen some commentary from Bank of Japan members talking about the possibility for intervention in the FX markets to strengthen the Japanese yen, well, by and large, there are a number of significant benefits to a weak yen for Japanese businesses and also for Japan as a whole, as you've seen booming numbers in terms of the tourist trade recently. Well, part of that is down to the increased affordability for someone coming from, say, the likes of the United States visiting Japan on holiday. In terms of the final chart I have here for you, it is a breakdown not only the Nikkei versus dollar yen, but bear in mind dollar yen is the US dollar against the Japanese yen. So I wanted to carry that relationship through with the Nikkei divided by the S&P 500. And so what we've seen here is essentially the gains in dollar yen have really seen an oversized move higher for the likes of the Nikkei compared to US stocks. So the question mark here is, are we going to see a reversal in terms of that dollar yen move, or are we going to see a continuation of it? The question mark really has got to lay with the Bank of Japan. Are they going to start laying the groundwork for any sort of protracted period of upside in terms of rates over in Japan? If so, then you could start to see this chart turn around as you start to see dollar yen rolling over, the possibility of the S&P outperforming the Nikkei 225. And so we could see some pressure on the Nikkei 225 if we see dollar yen weakening. The problem that we have here is that the US has not solved its inflation problems as things stand. So there's question marks about when are we going to see those interest rates cuts coming into the fore over in the US. Also question marks about could we end up seeing the next rate hike before we see a rate cut from the Federal Reserve. So certainly if we were in a position where the Federal Reserve were expected to cut rates in a month's time, then you'd likely see that divergence play out. But instead, we've got a year where people are talking about a potential 10 or 20 basis point hike from the Bank of Japan. And at the same time, we're not necessarily seeing that divergence widen much because the Federal Reserve is likely to hold off for some time yet. So really the key thing here is, do we start to see US inflation pressures start to come towards the downside, and that could weaken the US dollar? That would be one reason for dollar yen to start to roll over as we see that sort of haven demand start to dry up. And on the flip side, if we started to see a significantly hawkish tone coming out from the Bank of Japan, would that strengthen the Japanese yen? It's notable that that move out of negative rates didn't really herald much by way of upside for the yen. And that comes in part because of the fact that markets are really focusing on this rejigging. Earlier in the year, we were expecting 7 rate cuts from the Federal Reserve. Now we're talking about 3, Two, are we going to see one? Will we see one at all? And so it's really difficult to see this turnaround happening in terms of the dollar yen. Instead, it continues to push towards the upside. I'm just going to show you things from a charting perspective. Let's go full screen here. First and foremost, this is the Nikkei 225. So remember, the Nikkei 225 generally does well as dollar yen does well. So let's just put dollar yen onto this chart as well. There we go. So dollar yen, here, I tell you what, let me put this onto another scale, pin to a new right scale. There we go. Okay, so if you're looking from a wider perspective, you can see that gains in terms of dollar yen have resulted in gains in terms of the Nikkei 225. We have seen this pullback coming into play of late, but we haven't necessarily seen that come into the fore for dollar yen. And so that would point towards a possibility that we're bottoming out here and that we're going to rally. You can see the 76.4 Fibonacci playing out perfectly as things stand for the Nikkei 225. So with dollar yen gaining ground, are we going to see that move towards the upside? Well, look out for the Bank of Japan meeting. Do they come out with a really hawkish tone and signal multiple rate hikes over the course of the year? Well, that could lead to further downside for the Nikkei 225. And certainly if we're looking over the near term, you could say, well, look, if we stay below this neckline that we have here, where we've got the prior low here, well, let's just get the regular pricing on here on 38301. Essentially that swing high and that prior low provides a key resistance level that needs to break out of this near-term rebound. You can see the 76.4 being tagged perfectly here around about 37885. So there's still question marks around about this market, and if we come out of a really hawkish tone from the Bank of Japan, we could see another leg lower coming into play. If we don't, and we see a relatively cautious tone from them where they're essentially happy to keep things as they are, and we see markets repricing away from those rate hikes this year, then we could see the likes of dollar yen gaining ground once again, and we could see the 76.4 as essentially the end of the sell-off for the Nikkei 225, and we push onwards and upwards and regain ground once again. So really look out for that tone, but the wider sort of outlook for this market remains bullish as things stand, despite this pullback that we've seen over the past month. And that dollar yen relationship does point towards a possibility of that continuing to play out as we see that that currency pair moving towards the upside once again, which, as I've noted, has significant beneficial consequences for Japanese businesses. In terms of the yen itself, here it is against a whole host of different currencies, and you can see exactly that uptrend playing out pretty much across the board. You can see CAD breaking out here, sterling and euro both consolidating and trying to break towards the upside. Aussie yen starting to push towards the upside. So what we can see here is that markets, by and large, despite the fact that we're coming into a potential rate decision where the Bank of Japan could lay the groundworks for another 10 or 20 basis points worth of hikes this year, markets don't really care that much, quite frankly. 10, 20 basis points worth of hikes isn't really that much to hang your hat on, considering the fact that most of these central banks are moving at 25, 50 basis points at a time over the course of the past couple of years. So, you know, if we do see markets actually care this time around, which they didn't last time around, if they did care, then we could potentially see some weakness coming into play. But if you look at the sort of wider perspective, all of these markets are very clearly defined in their uptrends. So we'll have to see whether price actually breaks down through key support over an intraday basis. Here's dollar yen. The monthly time frame shows you that massive breakout that we've seen recently, the break through that prior high that we have at 152, essentially, giving us a continuation signal. The ability of the Bank of Japan to support this currency is questionable. And you can see here that we are essentially looking at a market that is continuing to push onwards and upwards. So we've seen this pullback, this consolidation phase. Are we going to see another push towards the upside? Certainly, as long as we stay above this 155 kind of area, 154.7 area, then it looks like we could see another push towards the upside. But keep an eye out for these comments from the Bank of Japan. If they come out with particularly hawkish comments, maybe we see a bit of a pullback, and that pullback could also drive a bit of weakness for the Nikkei 225. But if that doesn't happen, and if they seem relatively happy with things as they are at the moment, then possibly we could just see a continuation of the trend. The trend is very clearly defined, and that means upside for dollar yen and outperformance for the Nikkei 225. If we see something from this meeting that shows that markets actually care this time around, that the Bank of Japan are planning to potentially raise interest rates, then we could see that pull back somewhat. But it's, I don't know what the opposite of a falling knife is, but it's a very clearly defined trend. I wouldn't necessarily want to stand in the way of it to a great extent. And 152 was supported. We've been blasting past that. Now seeing this consolidation, looking like we're going to break higher once again in the lead up to this key Bank of Japan interest rate decision for a currency that has been a great trade for many FX traders out there. I say it many times, but the role of a trader in my mind is to find the trend and take advantage of it. And this has been a really advantageous trade to be a part of. And there's a good chance that it does continue apace. It all comes down to whether markets actually believe the words that the Bank of Japan are saying, and particularly care, given the relatively slow and minimal pace of rate hikes that they could be laying out at the meeting overnight on Thursday night, Friday morning.